Welcome to S&P Capital IQ's monthly loan market overview clip. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends and discuss the outlook for the next 90 days. In preview, the market's technical bias improved during the home stretch of 2011, though conditions remain fragile. Looking ahead, visibility is low, with the capital markets still tracking the vicissitudes of Europe's erratic debt situation. The S&P LSTA index closed out 2011 with a 0.5% gain in December, bringing a quiet conclusion to a topsy-turvy year. As this slide shows, after a steady first half, loan returns plunged into the red in August in response to a run of bad news. That set up a strong October rally sparked by better-than-expected third-quarter economic growth in the U.S. and a positive turn in Europe's sovereign debt talks. The 2011 rollercoaster ride was hardly unique to the loan market. Risk assets generally followed Europe's ever-changing fortunes, which shifted regularly and with great effect. The fourth quarter comeback pushed loan returns for all of 2011 to 1.5% compared to 10.1% in 2010. Still, it was the S&P LSTA index's 13th gain in its 14-year history. The only down year, of course, remains 2008's 29% swoon. The loan market's technical equation came into balance in the fourth quarter after veering from strongly positive in the first half to sharply negative in August and September. Over the final 3 months of the year, anemic demand faced off against lackluster supply. Start with demand. Between October and December, outflows from loan mutual funds moderated, while CLO volume perked up to a post-credit crunch high of $4.4 billion. On the other side of the ledger, new issue institutional volume fell in the fourth quarter to a two-year low of $26 billion. Looking ahead, the prospects for loan volume in early 2012 are uninspiring. Arrangers have reined in underwriting commitments in the face of uncertain demand. As a result, LCD's forward calendar of M&A-related deals fell to an 11-month low of $4.6 billion at year-end. Until conditions improve, most participants expect the loan market to continue to operate as it did in the fourth quarter, when the new issue window opened and narrowed frequently in response to shifting investor sentiment. That will likely limit volume of large LBOs for the time being and keep activity centered on middle market deals, tuck-in acquisitions, extensions, and refinancings. With demand and supply in equilibrium, secondary loan levels were range-bound in December. Better-rated credits, bolstered by CLO and bank demand, outperformed during the final month of the year, as did high-beta names that appeal to relative value accounts. Distressed paper, meanwhile, limped to the finish, with CCC-rated loans losing nearly a point in December. Similarly, the average new issue clearing yield moved sideways in December after narrowing significantly in November. While yields were unmoved, no fewer than two issuers were able to strip maintenance covenant tests as a result of strong primary demand, 99-cent stores and Capital Safety. Looking ahead, participants think the market will remain bifurcated, with BB loans clearing routinely inside of 5%, while single B paper prints in a 6 to 7% band. The loan default rate ended 2011 at a near record low of 17 basis points, down from 1.9% a year earlier. Looking ahead, managers expect the rate to rise to around 2% in 2012 as a result of some difficult situations in the media and publishing sectors. That compares to a 3.5% historical average. Needless to say, if the EU situation deteriorates, the pain will increase, forcing default rates higher still. To wrap up, a few final points. Participants expect a slow start to 2012 with activity centered on middle market deals, tuck-in acquisitions, and pro-rata paper. Further out, as the EU goes, so will likely go loan market activity. Again, this point is not exclusive to loans. With this in mind, arrangers expect the loan market to continue to follow the bond market's playbook, with a window for new deals opening when investor sentiment improves and narrowing when investors are spooked. Improving conditions breathe some life into the amend to extend trade in December. Indeed, Michaels Stores and Kronos were the first two institutional loan issuers to tap the market for extensions since June. Arrangers expect issuers with 2013 and 14 loan maturities to test the market for extensions early in the year. Based on Michaels and Kronos, the cost of extending today is roughly 100 basis points wider than it was in early 2011 when liquidity was flowing. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description below. You can also download this presentation at slideshare.net. Finally, here's our standard disclaimer.